Welcome back to the Wall Street Podcast. Today we're doing a deep dive into a recent Bank of America securities report. It's titled Walmart Inc. 2Q Preview Bull Bear, Coincides Share Gains and Improving Profitability versus High Valuation, and it just came out on August 18th, 2025.
That's right. This report gives a pretty detailed outlook on Walmart, ticker WMT, just ahead of their second quarter earnings release. It breaks down the Q2 estimates, looks at their key growth areas like convenience and digital ads, how they're handling tariffs, and it lays out the bull versus bear case, especially with that valuation near 20-year highs.
Okay, let's jump into that F2Q performance first and what's really driving their growth. BofA is forecasting, 370 cents adjusted EPS and about 3.5% growth for U.S. comparable store sales.
Yes, VM 70 cents at JEPS and plus 3.5% U.S. comps. But interestingly, there's some external data from Bloomberg Second Measure that suggests comps might actually beat that. It points to sales accelerating for Walmart during the quarter.
And that acceleration comes down to?
It really seems tied to their big push on convenience and value. They're integrating everything, groceries, general merchandise, pharmacy, into single orders. And the plan is to get same-day delivery coverage to 95% of the U.S. population by the end of this year. They're really using their stores, you see, as local fulfillment hubs. It's a smart play, especially for fresh items.
Right, leveraging that physical footprint. Now, beyond the core retail, the report highlights digital advertising, calls it a strong growth engine.
Oh, definitely. It's been growing at, 40% annually for the last 4 years? It's a significant part of the story now.
So what does that mean for the bottom line, for profitability?
It's becoming fundamental. BofA projects these digital and ancillary businesses will drive 2/3 of Walmart's future profit growth. They already tipped U.S. e-commerce into profitability back in Q1. And as Walmart scale, their omnichannel setup, plus growth in their third-party marketplace and the Vizio acquisition. All these things feed into expanding that digital ad revenue, even if the broader economy is a bit challenging.
Okay, let's talk valuation then. BofA is keeping a buy rating, a $120 price target. They like the sustained share gains, improving long-term profit picture. But that PE ratio, 34 times earnings, that's pretty steep, right? Close to 20-year highs, as you mentioned. Some analysts see that as a tough hurdle.
It is high, no question. The report acknowledges that. But the argument BofA makes is that it's actually warranted. They believe the company's digital transformation, unlocking these high-margin income streams like advertising. It justifies looking at Walmart differently now. It's not just a retailer anymore. It's evolving. It's sort of a tech and logistics platform, too.
Interesting perspective. Let's dig into a few specific questions. First, what's the main reason Walmart is gaining market share, particularly with higher income shoppers?
Well, the report points to a mix. Their price leadership, obviously, but also the digital convenience, the easy pickup and delivery options they've rolled out. Consumers are still feeling the pinch from higher grocery prices, so they're drifting towards value players. And Walmart's growth in monthly active users in the U.S., especially in July, was apparently much stronger than competitors like Amazon or Target. Suggests they're really broadening their appeal.
Makes sense. Okay, second question. Tariffs and global sourcing, always a hot topic for retailers. How's Walmart handling that complexity?
They're seen as being in a relatively good spot. Why? Because their direct foreign sourcing exposure isn't as high as you might think. Only about 1/3 of their U.S. sales come from imports, and China's estimated to be around 15% of that total. So combine that lower exposure with their sheer scale, their advanced pricing tools, inventory management, they can absorb or mitigate tariff impacts better than many others, gives them a kind of resilience.
Right, scale matters there. Lastly, what headwinds could realistically challenge this positive outlook for Walmart?
There are definitely risks. The report calls out a few key ones. Potentially weaker spending on non-essential discretionary items if inflation stays sticky. Then there's increased competition, especially as more players ramp up same-day fresh food delivery. And internally, there's the ongoing pressure from SG&A cost investments in tech, higher wages potentially growing faster than sales, which could squeeze margins. That's the deleverage risk.
So, pulling this all together, what does this BofA analysis suggest for the average consumer and maybe the wider economy?
I think the main takeaway is that Walmart's strategy, focusing on convenience, value, and building out this digital ecosystem, is likely to keep shaping how we all shop for groceries and other things. If food inflation picks up again and we see promotions still aren't back to pre-pandemic levels, Walmart's role as that discount leader could become even more vital for household budgets. And it does raise that bigger question, doesn't it? As giants like Walmart consolidate this omnichannel power, blending online and physical retail so effectively, what does that mean long-term for smaller local businesses, for the competitive landscape overall? Something to watch.